And a very warm welcome back to our Insider Interview series. I'm Dave Baxter here at II, and today our guest is Sat Duhra, the Portfolio Manager on the Henderson Far East Income Investment Trust. So Sat, many thanks for joining today.
Thank you.
So turning to performance to start off, it has been, I would argue it's been a mixed bag. On an absolute basis, it does look very strong, particularly in the last year. But the trust is lagging its rivals and even the markets. How would you explain that?
Yes, if you look at our positioning, it's much more broad-based than our peers. I mentioned some of the themes earlier. We talked about financial inclusion, infrastructure, those kind of. We think there's some great stories emerging outside of technology. However, the index has had a very narrow move. It's 3 or 4 stocks have been driving the index forward. So it's obviously the likes of Samsung, Hynix, TSMC, and they've become a much bigger part of the benchmark than even a year ago. And the rally seems to be getting narrower and narrower. Now, the risk for that is that we're buying names that are becoming more expensive and also have a lot of kind of risk around, monetization of AI and so on. And so we like the kind of broader story that's emerging in Asia, and we want to stick to that. In the last 12, 18 months, those names have performed exceptionally well. And we still own those names. So we do have Hynix and Samsung and TSMC. We have all those names, and they've done very well for us. However, we do have to manage that exposure because ultimately we are a value and income fund. And I think that if you look at periods, for example, when we did that repositioning at the end of 2023, there was a period then of 6-9 months where we outperformed the index and all of our peers because there was a broad market move. So we benefited from our value names in Korea and India, and that worked really well for us. But when the market really narrows down to just a few technology names, and our peers, we think, income and growth funds are looking very similar. They are very similar now, and people seem to have the same TSMC, Samsung, and whatever in really big size. And I think that's a risk going into the second half of this year where we see a lot more volatility. So I think, if you look at the volatility recently, that's actually worked quite well for us. We have been more defensive than all of our peers. We have been performing better because of that. And so that broad-based exposure to Asia, I think over the long term, is the best place to be. But obviously, when you have periods where you have a very narrow market leadership, that will be negative for us.
And you talk about being more defensive. Are there any particular companies in the fund that stand out as, serving that purpose?
So actually recently, I would say the telecommunications sector and financials have been rather defensive. And it's not that we're kind of stuck in these names because we think they will just not lose capital. There's actually a great story there. So, for example, Taiwanese financials, Singapore financials, they've been doing really well. I mean, even Chinese financials over the last couple of years have performed well. So these things actually have their own story, and they have been doing well. Energy is doing well. We have energy exposure. They have a very high yield in those particular exposures that we have, but also they perform well, obviously, off the back of rising oil price, but also increasing dividends and so on. So there are a bunch of other areas. Telecommunications also is a beneficiary of AI. These data centers get built, but they have to be connected up. And so these are the people that are doing that, and they're also paying very high dividends. And the capex of yesteryear, some of these crazy spectrum auctions, which really put a lot of pressure on the balance sheets of these companies, that's over. So now we see high free cash flow, balance sheets getting stronger, and that's been a good area as well. So there's a number of areas that are really performing really quite in a resilient manner, which are things that appeal to us. They have value, they have income, they have strong balance sheets. So alongside that, we try and manage that balance.
So we could talk all day if we wanted to about the TSMCs and so on, the big beasts of the index. What promising, lesser-known shares sit in the portfolio at the minute?
So actually, I think there's a layer below these big technology companies. Of course, these are the direct beneficiaries of AI, but there are some more kind of, I would say, indirect beneficiaries, so the second order effect. And that's something like Keppel in Singapore. It's a company we've owned for a little while now. It's a Singapore company. It's transformed itself from being an oil and gas company, kind of offshore marine and so on, and property development in China and other places. It's selling down those exposures and using the cash to reinvent itself as an infrastructure company. So it does, for example, subsea cables, it has power generation, it does data centers. So it's really in the mix when it comes to AI, but it's making real money. There's real exposure there for things that are really going to last for years and years to come. So that repositioning the market is rewarding that repositioning, but also is leading to higher dividends. And so we think that dividends will increase as the years go by. And as they sell down some of those property assets, they will continue to reposition the business. So we think that's an interesting story that is also a beneficiary of AI.
Is there much in the way of those, I suppose, kind of picks and shovels plays at the minute relating to the kind of AI boom and all of that?
I think there is a whole bunch of them actually, and something we've been looking at. So we've been taking some of our exposure down from the kind of large cap, more obvious names and adding to these kind of names. So, for example, CATL in China, the battery player, the largest lithium battery player in the world, provides batteries for Teslas and BMWs and so on, but also energy storage. So energy storage is a really key theme when you think about infrastructure, and that's something we really like, and we think that we really want to broaden out the base of exposure for our portfolio. We don't just want to be sitting there with about 30%, in three names, and just have a benefit from this narrow move. But what happens after that? I mean, we've seen volatility in recent times, and that's been beneficial for us in a relative point of view. We've been more defensive because of these kind of things. They produce real cash flow. They are still cheap. They have strong balance sheets, and they're not really well covered. I mean, people don't really talk about Keppel or CATL as much as they do about some of these high-tech, Taiwanese and Korean names. So I think there's a whole bunch of the market that's been ignored. And our job really, Thailand, for example, has done very well. We've been adding to Thailand in recent months. That's done very well. So there's a whole bunch of things that have been ignored in this whole kind of AI rush.
And if we gaze out now to the next 12 months or so, what would you say are the biggest risks and the biggest opportunities for Asian equities?
So I think the risks really are, currency, geopolitical, and those things that we talk about affecting South Asia. The government policy risk. I think South Asia still faces those risks. In terms of inflation and so on. Inflation is probably going to move higher. I mean, that will create some dislocation in some of those markets, and I think that's something to watch out for. Now, the way we mitigate that is that obviously our exposure is more North Asia, so we have less, less to be worried about when that happens, and actually it's happening now. The opportunities really are very significant because some of these trends that have been emerging for a number of years now, when we talk about some of these consumer companies, for example, in China going overseas, we talk about technology supply chains, infrastructure, but also corporate reform. So these things are here to stay. So the corporate reform we're seeing, I think outside of Japan, is some of the most compelling initiatives from regulators to boost dividends, boost buybacks, and simplify corporate structures. That's happening in Korea because obviously that was the first kind of player in that, took a leaf out of Japan's book. China's doing that, and I think people don't realize how much China's pushing companies to explain why they're trading below 1x price to book, getting SOEs to pay more dividends and buybacks and so on. It's happening in Singapore. So there's an equity program going on from the MAS where they are encouraging more investment into the market, seeing more dividends, more buybacks. That's very positive. Even in Indonesia, there's a sovereign wealth fund that's taken charge of the SOEs, and some of the yields there can be 8, 9, 10% for companies. So there's a whole bunch of things going on across Asia that are very positive, and these are things that will survive any kind of meltdown in AI if that happens.
So let's return to China. That's always been a source of quite a lot of debate in the last 5, 6 years. It did rally quite hard last year, but it's lagged some of those more AI-focused markets like Korea. What's your view on China and how are you invested there?
The China market had a really poor period of 3, 4 years, and then more recently, partly because of AI. I mean, there's some very strong kind of AI players in China. Some of them not as well known, but a lot of IPOs of these names. That has driven the market kind of in the right direction because they have just performed so well, and people are kind of scrambling to buy these kind of names. So that's an interesting area, but not really for us because we look for companies that are actually generating good free cash flow, that have strong balance sheets and a bit more established, where we feel there's less risk, and certainly from a management point of view as well. But the one area that's really been kind of ignored by foreign investors, I think, is the high yield names in China. So if you look at, for example, some of our best performers over the last 12, 18 months, they have been China financials. Insurance has done very well in China. Aluminium, our China Hongqiao, which is an largest aluminium manufacturer in the world, had an 11% yield when we bought that, and then it doubled. And so there's a whole bunch of names there, with some very high yield exposures in China. And actually, the trend is quite positive for that because interest rates are falling in China, bond yields are falling, And domestic insurance companies are being told to buy more domestic equities. So this is why these high yield companies are still performing very well. So, and they're also very defensive. So on days when you see a bit of a shock to AI names, these kind of names outperform. And so we think that's a good part of the market. Now, having said that, we don't really like the macro in China. We think there's a lot of risks. Property is still very weak. And until that recovers, consumer sentiment just won't recover. And I think it's a real drag on overall growth as well. So, that's something I don't think is going to happen in the next few months. And I think the macro will be under a lot of pressure. So it will keep us probably underweight in terms of the overall China position. But within that, those high yield names are very attractive. Batteries, CATL are very attractive. There are a few other things in terms of technology that are emerging as very key exposures as well.
And how much of I suppose, a black swan is the kind of regulatory risk and so on in China? We saw people get pretty blindsided by a regulatory crackdown back in 2020, 2021.
Yeah.
How is that looking now?
It seemed to have died down for a while. And then recently we've seen some more of that regulation route. It is a risk. And I think if you invest in China, that's something you have to be wary of. And that really has made us, in terms of our exposure in China, most of it is probably more state-owned enterprise exposed. And I think the risk there is much less because the government has a share in those businesses. And what they are focusing on is really boosting dividends and simplifying structures and making them more efficient. So there's a lot of that going on. They want to boost the ROE of these companies as well, the same way Korea and Japan are doing. So there is a drive underway to boost the performance of these SOEs. I think that's a good place to be because they are paying very high yields. They have resilient balance sheets. And I think some of those risks around local government financing vehicles, around the property market, are starting to dissipate to a degree. I mean, they're still there, but they're certainly not as bad as they were 3 years ago. And that created an opportunity for us a couple of years back to go into those names. And they've done well since. So, it's not a great exposure for us, but I think it's something that is ignored and creates potentially some great opportunities.
And we have kind of covered this to an extent, but Asia and the emerging markets recently have gathered some of their own concerns around market concentration and the concentration of returns. What's your view here and how are you dealing with that as a fund manager?
Yeah, I mean, we used to look at the US and look at the concentration risk, and now our markets are even more concentrated. So I think it is always a risk because, as we've said, there is a lot of retail participation. For example, in Korea, there are 2 times, 3 times leveraged ETFs on these single stock names. I mean, there are some kind of orange flags coming up on some of these things, and we just want to be a bit wary of that. And so the index is very much dominated by these big technology companies, which are actually really high quality, high growth companies. So it's great. We have exposure to that, but we have to manage that risk. And so again, as I say, we want a broad balance, in terms of country and sector. And we think that when there's a bit of a shakeup in some of these names, then, that will be good for us from a relative point of view in terms of relative performance. And we're seeing that on some of these days when there's a bit of shakeup on some of these AI names. So I think that, it is a risk to our markets because if AI story does fall over, then obviously a market like Korea will be very severely impacted. And so we have been managing down some of those exposures and moving into some of these second derivatives of AI and also these other stories that are going on outside of that, in the financial space, for example, or infrastructure or whatever it may be. So I think it's something that one has to be wary of. And we don't look at the benchmark in that respect. I mean, we don't have an official benchmark, but our objective is very clear, is to grow our income. So income is a key focus. But what we've shifted really since the end of 2023 is the income and alongside that exposure to these great themes. And some of that, sometimes it's been India, currently it's technology, but we will move the portfolio where we see appropriate to capture that growth, but not compromise on the income. And that's really the key thing that we do.
Finally, our usual question, do you have skin in the game?
Yes. So I invest in the fund. It's important to do that. I go around speaking to clients and telling them about the fund, so I should be invested too. So that's a very important thing, I think, and I will continue to do that in the years ahead as well.
So thanks for your time.
Thank you very much.
And thank you for watching. As ever, do let us know what you think in the comments. And if you're a big fan of this series, hit the like button and hit the subscribe button. Thanks and take care.